Good afternoon from a very chilly London, and welcome to this ARK Invest webinar on our latest strategy here in Europe, the ARK Space and Defence Innovation UCITS ETF. I'm delighted today to be joined by Rahul Bhushan, who is our Global Head of Investment Products. So I work very closely with Rahul on the product development management side of things, as well as with clients to promote an understanding of our product range. We also, from our investment team, we have Tasha Akini, who is Director of Investment Analysts and Institutional Strategies. She is responsible for overseeing all of our models, but has a particular focus on autonomous technology. And we also have Daniel Maguire, who is a research analyst focusing on autonomous technology and robotics. So today's agenda, we're going to start with a very brief introduction into ARK Invest for those of you who are not familiar with the firm. We're then going to look at why we built this ETF, why we brought it to the European market, and what makes it different to the other defense funds which are in the market. We'll then do a deeper dive with Daniel and Tasha into some of our highest conviction names and why these are included in the fund. We'll then look at the portfolio characteristics and how we construct that portfolio, and we'll end finally on a Q&A session. Now, just before we begin, I'm sure you're kind of all familiar with the usual drill. You can ask questions at any point during the webinar. I also just wanted to highlight that we have live captions enabled, so you can translate in real time what we're saying into a language of your choice. So that's a feature that you can enable as well. So let's crack on then. So introduction, I'm just going to do this very quickly. For those of you who don't know ARK Invest, we were founded in January 2014 by Cathy Wood, essentially to democratize access to disruptive innovation investing. So we're around $35 billion of assets under management globally, over 80 employees. Our headquarters is in St. Pete in Florida. And our four kind of business pillars, if you like, are disruptive innovation listed equities, venture private assets, digital assets, and also sustainability and impact. And whilst, that's not as relevant for today, that relates to the Rise ETF range, which Rahul was a co-founder, and that was acquired by ARK Invest a few years ago, which has now become ARK Invest Europe. So that's a kind of quick roundup of ARK Invest. You can see here our latest product lineup with ARK Space and Defence Innovation sat at the top alongside three other active ETFs that we've launched over the past few years. There's been really kind of strong interest from our clients in these, particularly this year. So I'd just like to highlight that our artificial intelligence robotics ETF and the ARK Innovation, which is our flagship strategy here in Europe, we both have, or both of these have over $300 million in assets under management now. So we've had a great year in terms of kind of client interest for these funds. And then at the bottom, you can see the Rise range as well. So with that introduction out of the way, we're going to turn to our first kind of real section. So this is with Rahul. So Rahul, I was hoping you could tell us a bit more about why we built the ARK Space and Defence Innovation UCITS ETF. And I think, if you could kind of touch on what the thematic investment case is for including both space and defence in this exposure, and how does this differ to some of the other strategies that we already see in the marketplace?
Thank you very much, Tom. It's a great first question. So the short answer is that what we've seen in the market over the last, I would say, couple of years is that the structure of defense innovation has changed faster than the structure of defense investing. What started as defense investments were these MSCI benchmarks focused on aerospace and defense companies, and the first range of ETFs that we saw when the thematic investing movement around defense really took off were index benchmark products, typically market cap weighted, with perhaps some tech oriented lean or tilt. But I think what we're seeing now, and certainly this is how we're approaching it, is this sort of version 2, if you will, or the second permutation of products that we think are going to be active, that are going to be a bit more thoughtful, that are going to be more high conviction, that are going to have not just a tech lean, but a innovation-oriented focus. And so that's how we've approached it. So there's three things broadly, I think, that we would say have shifted simultaneously in the past few years. So the one is the pace of learning and learning curve specifically. And I think Tasha and Daniel will touch on this specifically as we go into some company examples. The other one is the sources of innovation. And then the third, of course, is the technological bridge that we're today witnessing between space and defense. And our view is that unless you recognize all three of these shifts, what you end up doing in a defense or space and defense exposure is you end up owning the past, not the future. So, to unpack that a little bit, how do we think about it? Well, defense used to be about platforms and long-term procurement cycles. And what's changed is that today that's no longer about, it's no longer about platforms and long procurement cycles. It's actually about software, iteration speed, data, all the things that have been central to some of the other technological revolutions that we focus on in our research process are highly applicable to how the defense industry is changing. So regime shift, where we're moving from these platform-centric defense model to a software-driven one, slow RFP cycles that, in Europe, these RFP cycles can take 7 to 15 years. And that's changing to these, rapid learning cycles and dual-use innovation. And it all makes sense when you consider that the Ukraine war compressed, call it 10 years of defense learning into what was probably 18, what is still very short timeframes, but I'd say 18 to 24 months. So a question is, does war wait for procurement, or does procurement catch up to war? And we would make the argument that modern warfare is moving at software speed, not industrial speed. If you take some case studies from Ukraine, for example, battlefield drone concepts have been iterated multiple times per month. You've seen AI-driven artillery targeting where tools have been deployed in a matter of weeks. You've seen commercial satellite firms providing live tactical feeds, and there's this kind of fast learning cycle there, which is very, very interesting on the one hand, to see how the commercial innovation is entering defense faster than defense, and this happened historically, is entering the commercial side. And it's that sort of inversion where, we think a lot of the investment opportunity today lies. The other point I'd say to your question is this notion of technological convergence, right? So we see that space and defense are no longer separate industries. When you think of technologies like ISR, hypersonics, AI targeting, secure communications, autonomous mobility, these things all touch both of these domains, right? You don't have an effective 21st century defense stack without orbital infrastructure, or without that orbital infrastructure transmitting live data feeds to autonomous systems. And so you can think of space as kind of a logistics layer for terrestrial military systems. So there's increasingly a clear bridge between space and defense, and so we intentionally, in building this product, chose to combine those two domains into the same investment exposure. And so that's something that hopefully more and more investors, as we move into 2026, 2027, will start to recognize. And we think we're early in thinking about those two things as a convergence, but we think the market will move in that direction. And so how do you own this inside of if we move to slide, I think it's the next slide, Tom, on this one. So if we move to this slide, why this ETF? how do you access this inside of a public equities exposure? Well, number one, we think that traditional aerospace and defense indices have significant overweight to 20th century primes. So they miss the innovation layer entirely. If you have a market cap index focused on this area, then what you're saying is that the largest company is the most relevant company. We would say actually the fastest learning company is the most valuable company. So actually the fund is actively not replicating exposure found in peers, which if any investor, if you're potentially investor in this area, then if you unpack this fund, you very quickly realize that there's very little peer overlap. We're looking at 20 to 25% peer overlap in this product, whereas that could be 80 to 90% where you look at just a generalist thematic defense focused fund versus an MSCI, call it aerospace and defense ETF, which have been around for a very long time. And I think Tom, you're going to go into the visuals around this a little bit later in the presentation. I think the other element here is this notion of dual use innovation. So it's not enough to have low overlap, right? Because the question is, what are you not overlapping? So you've got to make sure that the things that are not overlapping are future relevant. So this is where our sort of dual use thesis comes to the fore, in thinking about how we've built the focus inside of this ETF. And Dan is and Tasha will illustrate this with a couple of company examples, but the idea is our focus is where the commercial R&D pays for the military capability, right? Not the other way around. So our research would suggest that where unit economics are improving fastest, where there are learning curves, and crucially where competitive advantages are compounding fastest as a result of the unit economics and learning curves. That's where you want your focus to be. That's where you want your exposure to be. And those are really the areas that we deem to be the most future relevant. So if you have a defense allocation that still mirrors, the industrial defense hierarchies of 2005 or 2010, or if your defense allocation is just allocating to companies that maybe have some generic exposure to defense tech, chances are very high, we would argue, that you're structurally under-allocated to the technologies that are going to be driving capability dominance in the future. And so your job as a fund investor in this space has to be to position your capital to where learning curves converge, right? And that's, for us, where we think that's certainly in the case of our product, our research is driving our stock selection in that way. And if you move to the last slide, Tom, here's a helpful visual that we've put together, which I think which has certainly helped us think about what's important in building a product like this. But I think you can flip that and say, well, what as an investor should you be thinking about if you're looking to allocate to defense? And we identify at least these three reasons why space and defense allocations are portfolio relevant discussions today. The first one is the most obvious one. As a percentage of GDP, defense spending is rising. It's not just in Europe, it's also in other places. And so that's number one. Number two is this idea of technology diffusion. So innovation flows from commercial into defense as opposed to the other way around. And we don't think that equity markets have calibrated to this inversion at the moment. So there are a lot of opportunities to seize. And then the third consideration is around the learning curve economics. Software-based defense compounds advantages in terms of data. And so we think that dynamic will create outsized equity winners, even in small universes, but where you have this winner take most dynamic. And so that's why our portfolio looks the way it looks, but also why we have that high concentration at the top. And so what we've seen actually in speaking to a lot of investors is there's been a lot of focus on the first point here, around the strategic necessity and allocations driven into this theme. Um, really just thinking about that. And we would argue that if you're allocating capital for 2, 3, 5, 10 years, then actually point 2 and 3 matter much significantly more, and arguably much, much, much more. So if you're open to that possibility that, uh, shifts in defense, or opportunities in defense could exist outside of traditional defense indices and benchmarks, or if you're less than confident that your current manager has been thoughtful about those points 2 and 3, then maybe there are better solutions out there. And certainly this is why we've come out now in October, November with this ETF.
Thanks, Rahul. And yes, we'll certainly kind of touch on some of those points again in the kind of last section or the penultimate section, specifically how we differ to the competition in our approach. So Tasha, Daniel, thank you again for joining us. So I think Rahul did a nice job there of kind of discussing the thematic investment case for this theme. But what I was hoping you could do now is talk about some of our highest conviction ideas, where you're kind of seeing the strongest growth opportunities at the moment within kind of space and defense innovation theme.
Sure. And thanks everyone for joining and participating in the call. And so I think it's worth contextualizing why we think the space ecosystem is starting to hit prime time. And really, this is thanks to declining launch costs, which you can see on the screen. So it's worth setting the scene here before we talk about some of our high conviction names. So foundational to ARK's research is the concept of Wright's law. And for those of you who aren't familiar with Wright's law, it's for every cumulative doubling in a given metric, cost will decline by a constant percentage. And this trend has held true over several innovative platforms over time. So as you can see on the screen, in the case of rockets, this is for every doubling, cumulative doubling in up mass, meaning metric ton or kilogram you can get to orbit, the launch cost per kilogram of getting that mass to orbit declines by a constant percent. And our research suggests that's around 17%. So why is this important? Well, when the space shuttle program launched in the 70s and 80s, it was a partially reusable rocket program. It cost around $1.5 billion to launch, and a lot of industry experts said it's not going to be feasible to ride down the cost curve in order to make reusable rockets a cost-effective solution. But fortunately, in the early 2000s, SpaceX flipped the script thanks to its Falcon 9 rocket. So the space shuttle program, as I mentioned, on a cost per kilogram basis, that was around $80,000 per kilogram in today's dollars. Thanks to Falcon 9, that's now cut to under $1,000 today. And we think trending with Wright's law, thanks to SpaceX's Starship rocket, which is its next generation fully reusable rocket, this trend can continue and perhaps reach sub $100 per kilogram over time. And the reason I'm saying all of this is because what that enables is for the ecosystem to really open up. So this can enable the proliferation of satellites, which you see today with Starlink's internet connectivity. There's around 8,000 satellites orbiting the Earth, providing internet connectivity to those who can't access it through traditional means. Scientific discoveries enabling Mars exploration, national security and Golden Dome, which I'm sure we'll touch on. And even more recently in the news, the concept of data centers in orbit, which historically would have been laughed at, but now, given how cost effective it is to launch mass to orbit, it's really a serious consideration, particularly given the power shortages in the United States and around the world to power AI. So all of that was traditionally prohibited because of launch cost of space, and that's changing. So Tom, if you want to go to the next slide, I can talk about some of the companies that are enabling this change and also benefiting from it. So on the left, you have Rocket Lab. So Rocket Lab, for those of you who don't know, is a vertically integrated space-based company who, outside of SpaceX, is one of the most frequent launch providers in the United States and really around the world outside of China. They currently have a rocket called Electron, which is more on the smaller side of getting mass to orbit, but they're moving into the larger rocket size with its rocket called Neutron, which is intended to be a partially reusable rocket and similar to SpaceX's Falcon 9, which currently dominates the market. So Rocket Lab can facilitate all of these companies to getting their mass to orbit in a cost-effective manner and also in a timely manner too. In addition to their launch business, Rocket Lab has a really compelling space systems business. So not only do they provide the launch vehicle, they also provide solutions of the payload, which is essentially what goes into the rocket, which is launched to orbit. Some of you may have read about 2 spacecraft last week that were sent to Mars on a Jeff Bezos rocket, and Rocket Lab actually built those 2 spacecraft that are currently on the way and orbiting Earth right now. And then longer term, Rocket Lab's intention is to have its own satellite constellation working in communications. And while they haven't said what exactly it will be, a lot of people are speculating it'll be akin to Starlink and providing internet connectivity from the orbit. And then lastly, maybe on Rocket Lab, in terms of the dual use concept. So previously commercial applications, more recently they're leaning into defense applications. So they've made a lot of key strategic acquisitions over the last year and are really leaning into defense applications, particularly around satellite constellations. So they're currently involved in several national security satellite constellations and intend on bidding on future ones. So that's a really strong data point to show of the dual use technology. So that's kind of a high level Rocket Lab exposure. They're exposed both on the launch side as they are on the space system side. And then on the right, we have L3Harris. So L3Harris is an American defense firm. Our view of L3Harris is that they sit on the spectrum between the prime and neo-prime companies. So what I mean by that is, Rahul touched on earlier, the primes are the traditional defense companies that have been around for decades, the likes of Lockheed Martin and Northrop Grumman, etc. And then the neo-prime are the new kind of up-and-coming defense firms that are mainly venture or privately funded. And L3Harris sits in between those and tends to partner with both in what they call a trusted disruptor strategy to capture a significant share of a lot of the major program records in the United States. And importantly, in addition to partnering with the up-and-coming neo-primes, they also have a venture arm and invest in those too. So as it relates to launch versus space, on the launch side, L3Harris had an important acquisition a couple of years ago called Aerojet Rocketdyne. This is a company with deep history on the propulsion side. They provided a lot of the propulsion solutions to the space shuttle program back in the 70s and 80s. And today they also provide some of the engines on certain rocket providers. And in addition, they're really well exposed on what's known as solid rocket motors, which is a huge bottleneck in the US. And solid rocket motors propel most of the countermeasures that the United States and a lot of the governments are stockpiling up on. And there's only a handful of manufacturers in the United States, so L3Harris is well positioned there. And then just briefly on the space side, so they have a segment called Space Airborne Systems, and this should be a beneficiary from what I spoke about in terms of getting mass to orbit. L3Harris has a lot of compelling solutions on the defense side, particularly for sensing and tracking threats to certain nations. And they kind of sit right in the sweet spot of the concept of Golden Dome that you may have heard on the news, as well as other countries who are seeking their own countermeasures. So that's a kind of high level overview of 2 companies that ARK has high conviction in and reflected in our portfolio. And I can pass to Tasha now, who will discuss some more names in the defense space.
Thanks, Daniel. So on the next slide, so we're looking at AeroVironment and Kratos here. These are 2 drone providers. So in addition to the research that Daniel highlighted on rockets and space and satellite technology, within the defense space, AI is really unavoidable. The first, I would say like one of the most important applications of AI that we've really seen over the past 10 years is drone technology, which we know that, AI pilots are performing better than their human counterparts, right? You're putting fewer troops at risk with deployment of these technologies, and they really just work better. So starting with AeroVironment, this company has been a long-standing supplier of drones to the US military. Traditionally, they've been a leading supplier of small form factor drones, but they've expanded that envelope in recent years. They have an in-house autonomy development team. So they've been working on AI internally for quite some time. And they've also expanded that offerings through through acquisitions, which I'll talk about in a moment. Within drones, one burgeoning area here for them that's very important, given recent conflicts, is loitering munitions or kamikaze drones. And recently, actually, AeroVironment, it just closed this year. They acquired a company called Blue Halo. This gives them exposure to, not just all the traditional defense areas that we know them well for, but also space opportunities, because Blue Halo helps them offer satellite communications, space resilience, among other things. That also added to their maritime portfolio. Maritime machines are becoming increasingly important for what we call the Indo-PACOM, or the potential China-Taiwan conflict that could happen in the 2027 timeframe. With Kratos, Kratos is a provider of jet drone technology. So they provide high-powered jet drones, propulsion systems, and in recent years, they've also ventured into satellites as well. So they provide these virtualized ground systems through a platform called OpenSpace. It's an open architecture that can work with different satellite providers. They're a key supplier for hypersonic vehicles and components. They make their own solid rocket motors, as well as collaborative combat vehicles, or what they call loyal wingman vehicles. They partner with companies like Shield AI on autonomy. Going back to that comment that I said earlier about autonomy performing better than human pilots, this is one of those companies that have proved that. Kratos has long. One important thing to know about this company is that they've been a longtime innovator of what Raul talked about in the beginning, which is this idea of good enough versus exquisite. So the traditional prime defense companies are very good at making these exquisite machines. They are exactly to spec, for military requirements, and they're also very expensive. Kratos has always been about getting machines out that are good enough to meet requirements and that are lower cost. So for years, they've been nipping at the heels of the primes. And so, as we go forward, and we see a lot of work going into changing the procurement process, shortening those procurement windows, as well as changing requirements for the future of warfare, which is really AI enabled. These two companies are well positioned to benefit from that.
Great. Thank you, Tash and Daniel. That was really interesting. We've had some questions come in as well, which I will direct to you guys. But I just think we'll go quickly through the portfolio. Won't spend a huge amount of time on this, but just wanted to kind of show you kind of what the fund looks like in a portfolio, essentially. So yeah, ARK Space and Defense Innovation, we launched it last month. I believe it's the 23rd of October. It's similar to the strategy that we have in the US, so the US domiciled fund, which has been going since 2021. There's a difference of about 3 companies, which is due to ESG exclusions, which I'll touch on later. But it's essentially kind of very similar strategy-wise. In terms of, well, I guess at ARK, we don't really view the world through the traditional GIC sector lens. We think about it in terms of our innovation platforms, which are AI, robotics, energy storage, multi-omics, and blockchain as well. What this fund is doing is focusing on the convergences specifically within AI, robotics, and energy storage. In terms of kind of the active approach that we take, I think there's some interesting figures to highlight here. We have a very high active share to major market indices. You can see 87% the Nasdaq 100, 90% the S&P 500, and a kind of low overlap with those as well. And this really is testament to our approach. At ARK, we are very active, very high conviction. You'll notice this fund on the next slide is very concentrated. And that is, again, it's a function of the fact that we're looking for opportunities for growth, some of which you might find in benchmarks, but many of the most exciting long-term opportunities actually sit outside benchmarks. So kind of key point I wanted to make on this slide is we are very active in terms of how the fund compares to some of the other products in the market. I think there's another interesting thing to highlight on this slide is the kind of the bar chart we've got here, which essentially shows the breakdown. It's almost like a sector breakdown again across different areas of space and defense innovation. Now, obviously, orbital aerospace, suborbital aerospace, you would expect to see in a fund like this. we do often get asked why we have aerospace beneficiaries and enabling technologies as well. I think, with enabling technologies, we would consider companies like AMD that we have quite a high position in, Amazon, Nvidia. These kind of sit alongside the more pure play aerospace and defense names, and they're essentially providing the compute, the AI, and also the cloud layers that actually make modern space and defense systems actually function. So that's kind of why we include those in there, even though you might not think that they're kind of more kind of pure play stocks. We also have beneficiaries, and the simplest way to think about this, aerospace beneficiaries, are companies that are essentially benefiting from the innovation that's taking place here. So a company like Garmin, it provides direct space-enabled hardware through marine, aviation, and outdoor products. There's also a company called JD Logistics, which is building a drone and autonomous delivery network, which again benefits from some of the developments that we, seeing in the kind of world of space and defense innovation. On this next slide, again, just some more kind of portfolio characteristics breakdowns here. So again, you'll see our top 10 holdings there with a Kratos, AeroVironment. The 4 companies we just discussed are our 4 highest conviction names at the moment. It's also worth highlighting bottom left, market capitalization. So again, there's kind of a misconception, especially here in Europe, that a lot of our funds invest in small and micro caps and more speculative names. And that's just simply not the case with this fund. You'll see that actually most of the portfolio is in large and mega caps. So you have a more defensive economic growth profile in the fund because of that. We do have the GIC sector breakdown as well on the bottom right, even though, as I said on the previous slide, it's not really how we kind of think about things. But, needless to say, in an aerospace and defense fund, you will see a high kind of industrials and information tech exposure there. And then there's also the portfolio composition on the top right, which again gives you an idea of how this exposure cuts across different kind of technologies that fall into our kind of own innovation platform classification. The final slide I'm going to show you is basically what we've got here are some of the traditional defense funds and the competing ETFs here in the European market. And what we're looking at is some of the most popular holdings that are held across all these funds. So what I've essentially done is taken the combined weight of all the holdings and shown the top 20 with the highest combined weight. And I think, just glancing at this, I think it's pretty obvious that our approach is very different to the rest of these funds. It's different in quite a few ways. So obviously we don't invest in some of the largest defense primes that Rahul and Natasha talked about. We're not kind of, targeting that. We're looking for growth opportunities, which are, outside of that kind of domain. So we don't have any exposure to a lot of these companies that you'll see here on the left. When you take companies like Kratos and AeroVironment, yes, you'll see these in some of the other defense and innovation funds. But obviously they're in much smaller weightings. So again, this is just showing how active our approach is compared to some of these other funds in the market. What you'll also look at, if you can kind of compare these competing funds as traditional defense funds, they have significant overlap with each other. So in some cases, you'll see overlap as high as 80%. It's not only to each other. If you also take major market indices, you'll see a higher overlap to those as well. It's because they're not kind of taking that high active share approach that we kind of focus on. If you kind of look at our fund and how that compares to some of these, the maximum or the biggest overlap you'll see is around 22%. So I think, when you tie all of this together, our fund can act as a complement to some of these because it is essentially quite different in its exposure, but it also can act as a substitute for an investor who's looking for a perhaps more forward-looking way to kind of play that kind of space and defense innovation theme moving forward. Excellent. So that actually takes us to the end of the presentation and the Q&A section. So we did have a few questions come in. So I think we've got 3 here, which I will direct this to Natasha and Daniel. So the first question we've got here is, how do we actually determine the exact weighting of each stock? Is it based around market cap, or is it our kind of conviction in the name?
Sure, I'll start, and Daniel, feel free to hop in. So, at ARK first, everything starts with our proprietary research on innovation. That is the lens through which we find our holdings and through which we look at our holdings. Every name has a valuation. We evaluate our holdings on a 5-year or more time period. We look for a 15% compound annual growth rate or above over a 5-year period for us to invest in a name. We track that valuation relative to market movements, and we also qualitatively score our names in addition to the valuation work. So we judge all of our companies on whether or not we like, or how much we like the people, management culture, the governance of the company. We look at barriers to entry in the markets that they serve, the execution, the product leadership. Thesis risk, what are the areas of our research where we know that there is some variability and that we could be wrong on our thesis, as well as impact. So it's really a combination of the qualitative and the quantitative here to determine portfolio sizing. And as Tom mentioned, we are active managers, so we are trading on a daily basis. We are taking advantage of movements in the market to size those positions.
Lovely. Another question, I think this is probably quite an interesting one, actually. It's what's actually changed in the last few years, especially that makes space and defense a genuine long-term investment opportunity rather than just, there are a lot of themes which are kind of themes of the moment. They're quite cool and speculative, but what are the real long-term drivers? What's really happened recently that you think makes this a more compelling investment opportunity?
Yeah, well, I think Rahul summarized it well in the beginning. It's really this changing environment of how defense spending works, and also again what's needed in warfare. So this idea that you can take out a multi-million-dollar drone with something that maybe costs $1,000 or tens of thousands of dollars, or the reverse, you have to use a multi-million-dollar machine to take out something that's very inexpensive. That really doesn't work. And we've seen that highlighted in the conflicts really over the past few years, let's say. So going forward, AI is essential. Also, lower cost is essential. And we're seeing a lot of initiatives that'll change the way, for example, the U.S. military procures things. The Secretary of Defense, Pete Hegseth, has made a lot of announcements around this, that he's looking to speed up that process. There have been barriers that again here in the U.S. that have removed the speed or the timeline with which you can export things to allies internationally. So there's more international opportunities here. And really the focus now is on what I mentioned before, the sort of Indo-PACOM arena, and that's all in the defense space. And then Daniel, perhaps you can touch on some of the changes that have happened in the rocket launch area and sort of the satellite area as well.
Sure, yeah. So I probably somewhat answered this already, speaking about launch costs, but really hitting the prime time as it relates to Wright's Law. Falcon 9 has enabled that. There are other players, so Rocket Lab being one of the main publicly traded ones. Just last week, Blue Origin, which is a company owned by Jeff Bezos, launched its second rocket, successfully reaching orbit for the second time in a row. And going forward, as you think about cumulative upmass doubling, with all of these players who are starting to launch a lot more upmass, that starts to accelerate and then continues writing down Wright's Law. Particularly SpaceX and its Starship. For context, the first version of Starship will be able to launch roughly 4x the amount of mass per launch than Falcon 9. That will work its way towards upwards of 8x per launch. So when you think about going up that cumulative doubling, that just really accelerates that trend and assists with the costs. And then on the satellite front, traditionally for communications, a lot of satellites were in geosynchronous orbit, which is a lot further away, and it's one large satellite that beams down on Earth. The problem with that is that it takes a lot of time for the communication to reach Earth. It's very slow and not very reliable. Thanks to declining launch costs, a lot of satellites have proliferated in what's known as low Earth orbit. And that's really what's enabled Starlink, where it offers compelling internet service at a much cheaper cost and competitive with some of the terrestrial solutions. And then really to echo Tash's point on the defense, a lot of the names we spoke about, they have, for the most part, anticipated a lot of these changes and have invest heavily in R&D in advance of these requirements, in contrast to the traditional primes who tend to wait for direction from government. And that's really relevant for a lot of our highest conviction names.
And, I'll
Yeah.
also add something that Daniel touched on, which is, because ARK is a research first organization here, as we're active managers, for years we've been researching both the public and the private opportunities here. Of course, in the space area, you can't ignore all the innovation that's happening in the private space. So that, we get the benefit of, through the lens of innovation, knowing these companies very well, understanding how they could potentially disrupt public companies, understanding which public companies are best positioned to partner with those private companies or acquire them. Often the acquisitions that we see, we already knew the name through that research. So I think that's another important change that's really happened in this space over the past years.
Thanks, guys. Yeah, it's I find it fascinating what you were saying, Tash, about the changing kind of economics and reading about where using multi-million-pound missiles to shoot down drones that cost thousands of dollars is by definition not sustainable, and of course warrants change, right? You can't keep on doing the same thing as before. And of course, Dan, it was interesting what you were saying about declining cost curves, which of course fuels adoption across the kind of whole disruptive innovation domain. We've got one more question for you guys, which is how we kind of look at new companies. What has to be true for a company to make it into the fund? And can you give us an example of a recent addition, or perhaps a name that you've trimmed and why? So I don't know, guys, because we kind of talked about how we, what we look at to include companies. So maybe you could give an example of something that we've lowered our conviction in or we've removed from the fund.
Sure. I can start, and Tasha, feel free to jump in. And to quickly answer the first part of additions, I think Tasha already touched on it, but really looking at it from a research-driven lens, innovation first. But as it relates to maybe a name that we have been trimming recently, I can speak about Iridium Communications, which is a satellite provider in our portfolio. They operate in a really niche area where they provide resilient satellite communication. So think of it as like the SOS service, or really low bandwidth, but reliable mostly anywhere in the globe. So over the past several quarters, management have been indicating that Starlink, which is SpaceX's satellite service, had been penetrating a small portion of Iridium's business. Because of that, we had been closely monitoring the situation and meeting with management of Iridium every quarter to understand the situation. At the time, their defense was that without getting too technical, but the spectrum that they operate in is a global spectrum, and it works in really pretty much all environments, really bad weather. It's very resilient. In contrast, SpaceX's spectrum that they operated in, not being global, it was more regional, so it needed approval on a region by region basis, and it also was at a higher speed but less resilient. So you can think of Starlink like if you were to watch Netflix on your boat, you would use Starlink, but if you needed SOS service in a really bad weather storm, you'd use Iridium. So a lot of times they were companions to one another. However, that changed in September, in the sense that SpaceX acquired additional spectrum, which is more closely aligned to Iridium's unique spectrum and puts them more in direct competition. Because of that, we spoke directly with the CEO of Iridium, and as we always do with all of our companies, in close communication with the management team, and we really understood that this was more of a direct competition as opposed to previously, where it was only eating into a small portion of their business. That said, the impact is still 2 years away, because SpaceX have to get their new satellite constellation up, and as well all of the equipment that will be compatible with the spectrum they've acquired. It takes around 2 years to get those into consumer hands. So to reflect that change, Tasha mentioned a lot of the qualitative metrics we had. We adjusted some of those. We also revisited our valuation model to make sure that the thesis risk was correctly aligned. That said, the company still has compelling offerings. Outside of that, they have a particular offering that's a competitor to GPS, which is 1,000 times stronger. It's very resilient, as well as the spectrum that they have, which is extremely valuable because, as I mentioned, it's global. It operates anywhere. A lot of other spectrums require region by region. But taking the pros and cons of that is a name that perhaps conviction has lowered in recent months, and it's been reflected in our actively managed strategy and the position in the portfolio.
Lovely. Thanks, Dan. We did have just two more questions which were sent in ahead of the webinar. So one of them is what kind of weapons will be emitted from the index or the fund? Our head of sustainability, she's not on the webinar today, but she would want me to be as clear as I can in answering this. The summary of the kind of exclusions are controversial weapons. So, companies involved in controversial weapons as defined as cluster munitions, anti-personnel landmines, chemical and biological weapons, depleted uranium, those companies are excluded. So in terms of the impact that this has on our strategy versus the one that's been going in the US for some time, we exclude both Lockheed Martin and BWX as well. Both of these are flagged by MSCI for involvement in controversial weapons. The other, excuse me, the other thing that we look to exclude is nuclear weapons based on the Nuclear Non-Proliferation Treaty. So if we say that's the NPT, so companies are basically excluded if they're domiciled in a non-NPT state or if they support the nuclear weapons program of non-NPT states. And as a result of this, we have an exclusion which is Elbit Systems that derives around 1% of its revenue from components used in nuclear-capable aircraft for a non-NPT state. So hopefully that answers the question in terms of how we're excluding or what kind of weapons will be emitted from the fund. The final question was on a risk-reward basis, where would this new aerospace ETF sit relative to your other funds? So if we go back to here we go, our European products here. So hopefully I kind of got the message across that we as a firm, we're very active. So what we're not looking to do is build products that very closely resemble the benchmark, that hug the index. All of our funds have a very high level of active share to those major market indices. So, obviously this fund is targeting space and defense innovation. And if you look at our product lineup, you'll see that we also have an artificial intelligence and robotics ETF, which again is very targeted exposure in those two areas, and also genomic revolution. So all of these are kind of similar in terms of the risk return, and what we're trying to do is seek exposure to those growth opportunities, which are largely outside of benchmarks. And then we also have our ARK Innovation UCITS ETF, which is a mirror of our flagship strategy in the US that has around $15 billion of assets under management and a 10-year track record. And that's more diversified across all of our innovation platforms. So I'd say that's a more kind of diversified approach. The other three are targeting highly concentrated growth within certain sectors. But I think really, again, going back to the point of how we compare to other funds in the market and the major market indices, again, we're high active share, we're low overlap, and certainly kind of in this fund we do have exposure to off benchmark names, but we also have exposure to companies like AMD, like Amazon, and the kind of benefits of doing that is it overall gives you a slightly more defensive economic growth profile than you might get if you purely invested just in off benchmark opportunities. So overall, it's a kind of good mix, but hopefully that kind of answers the question of how they kind of fit into our product lineup. That was actually our final question, so I can give some time back. We can finish a little bit early. So just like to say thank you to everyone for joining in. Sorry for joining. We will be releasing or distributing a video of this webinar. So if, like me, you enjoy listening to this kind of thing while you're out jogging, you'll be able to do so when we send out that follow-up email. So yeah, with that, thank you very much for everyone for joining in, to the panelists, and thank you viewers for your time this afternoon. Thank you.
Thank you very much.
Thank you.